welcome to this week's live, and we're doing Q&A. So if you've got any questions, put them in the comments box, whether it's on Instagram or Facebook or YouTube or one of the other channels. I'll be more than happy to answer any questions that you've got on property investing or on property tax. If you can't hear me, put that in the comments box too, because the last couple of lives had some technical issues with the sound, which I hope we fixed. But just in case, feel free to let me know, and I'll make sure I fix that ASAP. We did get some questions in advance, so I'll cover those until anybody posts a question in one of the social media platforms. So a question from Vinay was that, what are your views on the equivalent of Section 24 interest relief commencing for limited companies? Obviously not good news for corporate landlords. So basically what Vinay is saying is Section 24 affects people who own residential property in their own name. And if that applies to limited companies, what's my view on that? Well, my view on that is quite simple, Vinay. It's that it wouldn't be very good news, because lots of landlords are buying properties through limited companies for different reasons. One of those reasons may be because of the finance cost and due to Section 24. And also, quite a few landlords who were able to have incorporated their portfolios from their own names or joint names into a limited company. So if Section 24 in some guise extends to limited companies, there are a lot of property investors who won't be happy bunnies. So it won't be good news. And I hope it doesn't happen. Simple as that, really. Second question here from Imran, who's saying he's been told that it's very expensive to set up a LLP to set up and run, and is mostly for businesses in millions and not for startups. Is that right? Please explain. Limited companies, in my view, are a very, LLPs, forgive me, are a very good business structure depending on what you're looking to do. So they offer you a lot of flexibility. They run quite similar to a partnership. So there's that flexibility in terms of ease of management and things you could do. But they offer you limited liability, the clue's in the name. And I think they're not as well used as they should be, especially by property investors and property developers. In terms of they're only used by businesses making millions, that's quite incorrect, Imran. I think the LLPs work extremely well for small businesses, and it's something that you should explore. In terms of them being costly to run, they would cost you as much as a limited company would do. So they're not that costly. Of course, more costly than if you had a sole trader business or property in your own name, but they aren't that costly compared to a limited company. Like I said, kind of a very similar price, and I don't want to quote you a price because the price depends on how much you're paying or how big your business is and what's going on. But there are some good things you can do with LLPs, which benefit you a lot, both in terms of pension payments and capital allowances. But in terms, furthermore, if you've got cars that you're using for business purposes, I think LLPs work well. If you've got children who work with you, as in your children, then having them as ordinary partners, that works well. You can split the profit share ratio, which you can't quite do if you've got a limited company and where you've got two shareholders who've got 50% shares each, for example. They both have to take 50% dividend each. You can have a dividend waiver, but then starts getting complicated. So with a LLP, it says you and somebody else, and you own 50% each of the LLP. You don't have to share the profit split 50-50 any 1 year. One partner could have 60%, for example. The other one could have 40%, and the following year it can change. That's just one example of quite a few different things you can do with an LLP. So I would highly recommend you explore that, because I think an LLP is a good animal and can be used holistically depending on the different types of property strategies that you are using. Third question here from Sarah, and she says, so would you recommend different limited companies for different property strategies, i.e. rent to rent, buy to let, service accommodation, commercial conversions, developments, etc.? Or are there any strategies we can combine in one limited company? So that depends, Sarah. If you put everything in one company, then you're mixing different businesses and you're increasing risk, because the risk level for service accommodation is very different to a single let, for example, very different to a commercial conversion, very different to new builds. So I'm a big fan of saying de-risk and have every type of strategy in a different structure, whether it's an LLP in your own name, a partnership, or a limited company. So I would always endorse have separate businesses in separate companies. It also gives you more transparency. You can see how much each company is making. You've then got the added complication of VAT, especially if you've got so much service accommodation. And then on top of that, if TOMS applies, the Tour Operators Management Scheme, that makes it complicated. And you've got partial exemption for VAT. You've got capital allowances for part of the business, for other parts of the business, no capital allowances. It gets really messy. And the way that the tax regime is changing from 2023, if your profits are more than £50,000, you've got then a marginal rate of tax to pay. When your profits go over £250,000, then you've got to pay 25% corporation tax. That also applies when you've got associated companies. So that might not be as relevant as some of the other examples. Then if you're obtaining funding, you've got different types of strategies going on. That makes it complicated. Sometimes funders don't like that. So I would say, Sarah, keep it all separate. And if you've got any follow-up questions on that, Sarah or anybody else, feel free to post them in the comments. I'll happily answer them for you. Next question is from Alice. And she's saying or asking, do you create a new limited company every time you purchase another buy-to-let? So to keep it very simple, Alice, the answer is no if you're buying buy-to-lets with the same ownership. So let's say you own 5 buy-to-lets in a limited company and you're looking to get a 6th one. There's no point you forming a new company for that 6th buy-to-let if it's exactly the same ownership, i.e. only you're going to own it, because you wouldn't want 6 companies for 6 properties that you own yourself. If, however, you've got an investor or a partner or an additional shareholder who wants to buy property with you, wants to do a project with you, then of course it makes sense for you to have a separate company, because you don't want to give them shares in your existing company. That creates tax consequences and it complicates everything, and they end up getting a share of what you've already got. So in that case, you're better off having a separate company, but only if the ownership changes. If it doesn't change, keep one standard company for all your investments, and that's the best way to do it, in my opinion. Next question is from Pete, who says, can you incorporate houses bought in your own name to be transferred to a limited company when they have outstanding mortgages? Do we incur stamp duty, land tax? So yes, you can incorporate your existing property portfolio into a limited company. There may be capital gains tax consequences on the uplift in value, and also stamp duty, land tax consequences. If you're able to demonstrate you have a business, then you can claim Section 162 incorporation relief, which means you won't have to pay the capital gains tax. If you have a partnership that exists and has been running, then you could avoid the stamp duty, land tax. But if both those scenarios don't exist and you've just got, let's say, 3 buy-to-let properties in your own name, you've had them for 10 or more years, for example, and you're looking to incorporate, although the length of ownership isn't important here, but the longer you've had it, the more likely that the higher the gain you've got over those years, then you'll have to pay capital gains tax and stamp duty, land tax. So you'll need to consider that. However, what you could consider, and you need to take advice on this, is if you've got mortgages, you will have to pay those mortgages off, and there may be redemption penalties, or you could create a deed of trust, and that partly depends on your mortgage terms and conditions, because if they state if there's a legal or beneficial change in ownership, and you need to let the mortgagee know, then if you don't let them know and create a deed of trust, that might cause problems for you. If that isn't the case, then obviously you can go down the deed of trust route and keep the mortgages in your own name and transfer the asset into a limited company. Okay, got a couple of questions on screen here. The first one is, hi Shaz, hi. Can you please recommend a property accountant in West London? I can't right now because no one comes to mind. But if you email me or send me a message through Facebook Messenger, I will more than happily find one in West London for you and share their contact details with you. Next question is from Shamim Mirza or Mirza. I've been in 4 rental partnership businesses with my wife for nearly 4 years. How will capital gains be treated if we incorporate? So if you've got 4 rental properties and you're in partnership, depends if any of those are HMOs. If they are, then you may qualify for Section 162 incorporation relief, which means you won't have to pay any capital gains tax when you incorporate. If they're single lets and they are managed externally by a managing agent, and let's say you've got a full-time job or a part-time job elsewhere, you don't spend much time in your property business, then I think you will struggle to claim Section 162 incorporation relief. It's difficult to give you a set number of properties, but usually when you've got 6 or more units, you end up spending more time on your property business, especially if you're managing the tenants yourself. That makes it more likely that you can qualify as a business for incorporation purposes. Shamim. Got another question here which says, hi Shaz, could you give us some tips on inheritance strategies? That's a very wide question, and some of the kind of obvious tips would be, think of possibly setting up trusts earlier. Think of, if you're passing assets down to your children, introducing them into the business earlier. If you have a limited company, giving them a different class of shares, ABC shares, to include them. If you've got an LLP, make them ordinary members. If you can gift some of your assets or your cash away to them, do that on a regular basis, because there are certain kind of exemptions and reliefs available if you give assets and money especially away, depending on how much it is, over the years, rather than saving it all up until the end. But if you haven't done any planning whatsoever, then also you can get insurance to cover your inheritance tax bill. So there's quite a few things you can do, and it's difficult for me to kind of reel them off unless you give me a scenario and say, this is the scenario, what are some of the things we could do? Shamim's come back and says, yes, 2 are HMOs. So if you've got 2 which are HMOs, I don't know how many units there are in each HMO, Shamim, so let's just, for this purpose, say there's 4 units in each HMO. That gives you 8, plus you've got 2 other properties, that gets you to 10. So on everything that I know so far, and I've done, I think with 10 units, we'd be reasonably comfortable saying you have a property business. So as long as you're doing more than 20 hours per week in that business, I think there's a good chance for you to say you have a property business, therefore there won't be any capital gains tax payable. But speak to a tax advisor, get the advice in writing so that you're fully covered. Question here from Alric, and he says, what's the best way to put money into a company? I assume obviously you're saying a limited company, so you can invest it in as a share capital, or later on as your share premium account. You can loan money, and if you're a director, the simplest thing I think to do is to loan money to your company, and then you can charge interest, and you may have to pay income tax on the interest element, depending on how much it is. There are some reliefs available for that, depending on whether you're a basic rate taxpayer or a high rate taxpayer or an additional rate taxpayer, and what your overall income is. And if you don't charge interest, you don't have to, by the way, and then that debt stands with the company, and the company can pay you off at some point in the future. When the company pays you off, there's no tax for you to pay personally, because obviously you paid tax on that income at some point in the past, so you can draw down those funds. If you're looking to obtain a mortgage, and there's a high director's loan account, that may affect the lending with some lenders, so that's something that you ought to be aware of. But I think you, just for tax purposes, having a director's loan account where money is owed to you is kind of the simplest way of doing it, really. Okay, final question here from Aisha, And she says, "Hi Shaz, can you tell me the advantage of owning a property for serviced accommodation in a limited liability partnership?" That's a popular topic today. "Rather than a limited company, is it only because of capital allowances?" So Aisha, capital allowances are a big one, and they make a huge difference. So if you're buying property on a regular basis and you're running serviced accommodation, you could possibly have two lots of capital allowances. The first one is when you actually buy the property. If there's any availability on capital allowances, and you'll have to obviously do that through your solicitor and possibly accountant when you're purchasing it with the seller. The second lot is when you spend money on the property to refurbish it and get it up to scratch for service accommodation. And if you've got enough of a pot, you could end up in a scenario, depending on how much profit you're making, by using those capital allowances and reducing your taxable profit to zero for quite a few years, especially if you're buying more units. That's one. Then making contributions into a pension scheme. So for our purposes, let's say a SAS, because I'm a big fan of SAS. I've got my own SAS. Anybody who doesn't know what a SAS is, it's a small self-administered scheme. I'm not qualified to give you financial advice, but what I can say to you, if you make contributions into a pension pot, you can make up to £40,000, as long as it's wholly and exclusively for business purposes every single year. And if you were part of a pension in the last 3 years, then and you've made no contributions, then you can carry forward those 3 years. So in any 1 year, you could possibly contribute £160,000. So that helps. If you've got a car, for example, and you run it through an LLP, there's no company car tax to pay, although you can only claim the business element. So let's say a car costs you, let's say £10,000 a year for all the costs all in, and you drive 70% business purposes and 30% for personal purposes. 70% of the cost you can claim through the company. That works well. In one of the earlier questions, Aisha, I covered some of the other things in terms of flexibility and having your children as shareholders and the profit share ratio. So those things help as well. So it's not kind of just capital allowances. There's more to it. And then you might want to have an operating or a management company, which is a limited company alongside the LLP, which might work well. Again, you need to take advice on that, and it depends on exactly what you're looking to do with your service accommodation business. But in a nutshell, it's more than capital allowances. Got another question here, which says, I was asking, can you claim R&D tax credit on your buy-to-let properties if they are in your personal name? Very simply, the answer is no, because R&D only applies to limited companies, and it has to be a trading business. And so if you were a property trader, i.e. building new houses or buying houses, redeveloping and selling or flipping on, then you could possibly claim R&D as long as you're overcoming some kind of a scientific hurdle, so to speak, or there's something that you're doing which is different, which doesn't exist in the marketplace right now. But as a buy-to-let landlord, R&D will not apply to you at all. So that's all of our questions covered that I had in advance. Thank you for everybody who sent those questions, and thank you for everybody who asked questions tonight. And I'll see you next week at 7 o'clock. And as you may or you may not know, I've got a tax book on property tax. If you're interested more in tax, that's for our Instagram people, and that's for everybody else. It's available on Amazon. It's the Property Investors Tax Guide. I've also got a YouTube channel, so feel free to subscribe to that and ask any questions. I'll happily answer them. And if you're on Facebook, we've got the Trust Property Tax group. Feel free to join that, contribute, share your own journey and stories, and ask questions. I'll happily answer as many questions as I can. So I hope you have a wonderful week ahead. Until next week, bye for now.